We're going to be looking at the Nonfarm's payroll release for today, January the 10th, 2014. And what we're going to first start out is, because not everybody in the class is equal, I'm going to have to explain to you, or I'm going to explain to you, exactly what this report is and why it is so important to traders. The Nonfarm's payroll report measures the change in the numbers of employed people during the previous month, excluding farm industry, and that's why it's called Nonfarm's payroll. As the U.S. creates more jobs, the better the economic health is, because it creates consumer spending and it creates consumer confidence, and that is the engine that pushes the wheel of the U.S. economy. So it's very, very important for this number to stay steady during good times, or during bad economic crisis to start climbing. Now, as you know, we've gone through several years of this economic financial crisis caused by the mortgage market and the housing market, and the U.S. is steadily recovering. Our GDP jumped up to 4.1% this quarter, which is a huge surge. Last month's Nonfarm's payroll report came in way higher than expected, and it looks like the U.S. is on full recovery mode. Now, one of the main reasons that traders were going to be looking at this report this week, as more so than in other reports, is because the Federal Reserve started to taper its monetary asset purchases last month by $10 billion. It was a big surprise when they did that, but also it was a big surprise last month when unemployment fell from 7.3% to 7.0%. Now, it's expected that the Feds will continue their tapering process and continue tapering through 2014 to the point where they are no longer purchasing assets in the marketplace. At the same time, they have to get rid of or sell off the assets that they've purchased. Now, this report today will be the final piece of data the Feds will look at before their January 29th meeting. If this report is very, very strong, it means that we're going to probably see the Feds increase their tapering and decrease their monthly purchases. And it could be as much as a $25 billion change. Nobody knows for sure, but this report will be that final key piece that comes into play. Now, anytime we want to trade news releases, they can be very profitable. They can be fun to trade. They're actually very enjoyable. It's one of my favorite ways to trade. I love trading off the economics counter and on economic events. Because you have to remember, when you're trading binary options, you're only looking for some event that's going to give a particular asset the movement to move in a particular direction at a particular time for a short period of time so you can make a trade. Now, the Nonfarm's payroll report is released the first Friday of each month at 8:30 a.m. Eastern Standard Time, except when there's holidays. So this month it was delayed. Instead of releasing it on the 3rd, it's being released today on the 10th. Now, the report that is going to be released today has several pieces of data attached to it. The first piece of data that we're going to get is the jobs creation. After that piece of data, and that first release of data, and all of this is released within minutes of it, but that first event will make the markets move, whether it's good, strong, or indifferent. But too many traders act or overreact to this first piece of data. The second piece of data that is released is called the revision. There's usually a revision to the prior month's release because they're getting this data and releasing it so quickly that throughout the next month they're tabulating and retabulating, and there's corrections. So after they release this month's, or it's actually December's job creation, they are going to be releasing a revision to the prior month. If there's a revision upward, that's going to give a little bit more push on the market positive. Is a revision downward, it's going to weigh a little bit on a market negative. After those two events, they're going to then release the unemployment number. Okay. Now, Unemployment is at 7.0%. We're not expecting it to fall. We're also not expecting it to climb. Now, especially during the holiday season, there are times because the unemployment number is adjusted. It's adjusted due to seasonal changes and dates and the way weeks end and everything else. So if it pegs up from 7 to 7.1%, it's slightly market negative, but it's not a horrible, horrible thing. If it pegs down to 6.9, it's a very positive event. Okay, so what we're looking at now is when do I start? Jesse, you can start trading whenever you like, but today we are trading the Nonfarm's payroll report, and there's nothing to trade until the releases actually comes out, which is right at the half hour. So what we're doing is we're analyzing right now the markets to make a decision as to what to do when the release happens. Okay, so the numbers we're looking at on the screen in front of us are the prices of the assets this morning. I have the currency and the commodities. Primarily the Nonfarm payroll report, because the U.S. dollar affects everything, is going to have an effect on all the currencies. But for this report and most evaluation, we're going to look at the euro, U.S. dollar, and gold. They are the two that are going to have the most serious reaction to this report. Sure, when the dollar jumps up, it's going to force down the Canadian dollar. It's going to force down the Australian dollar. It's going to have an effect everywhere. But this is where we primarily look to trade. So the euro was trading just a short little while ago when I did all this data before the class at 135.92. I think it has pegged down a little bit since then. I have some charts ready for us that I did after this. And gold is trading at 1232.80. Gold has been in a slight slump but staying right in its trading range. The euro is still overstated. It's way too high. The Eurozone recovery is nowhere near as strong as it should be. So we're looking at a chart right now, as soon as it pops up on the screen, that I did right before class. So this was at 12:58 I did this chart. So that was a few minutes ago. The euro was trading at 135.92. I went to FX Empire and I pulled up the pivot points. But since we're pulling this up so far ahead of the release, and the release is going to force this to happen, I went out to support 2 and resistance 2, which you can see circled below. This is the 135.82 and the 136.05, and I've placed this on the chart. See everybody where this is on the chart? This is the top line here is at 136.05, and the bottom line here is 135.82. Those are level 2 support and resistance lines around the current price. Because regardless of what happens when this release comes out, we're going to have movement. It is determining, which we're going to do in a few minutes, if the momentum's strong enough to keep pushing that asset in a direction that you can actually get a safe, profitable trade in. Okay. Now, this is the FOMC report that happened the last month. And this gave us a perfect view of the traders taking position before the release of the euro-US dollar and then the reaction to the euro-US dollar when the release happened. Okay. Now, last month what happened was we created a lot more jobs than were expected. So because of that, that made everybody immediately think that the Federal Reserve would start tapering last month. So it had a negative reaction. When we see this go up, that means the euro is climbing. That means the dollar is going down. The dollar retreated down to about 79 because of what the Federal Reserve might or might not do. Okay. And it was a beautiful action and reaction. You could see traders taking positions. You could see where the initial drop was down because the dollar got very strong, and then the traders realized it was such a strong report that the FOMC would probably start to taper. Now, this is gold this morning. So we can see that gold is steady, been pretty steady. This is at 10 a.m. this morning. This is at 11 a.m. Gold's been staying pretty steady at the 130-something range. It hasn't actually moved in several days, anything worthwhile talking about. Okay, now, Fed stimulus is like the country printing money. This means that when the U.S. dollar is weaker because there is more in circulation. So if the Feds turn off the tap, the dollar should climb and gold should fall. Now, what has happened since the FOMC decision to taper at the end of December is the dollar recovered from 79 all the way back to a recent high the other day at 81, like 81.20, something like that. And the dollar is relatively high. We should see the dollar up about 82. Okay, and we probably will if the Feds keep on tapering, and we will see gold continue to fall. Now, remember, just a month ago, gold was trading at $12.50, and it still closed down 28% for the year, because as the economy is getting better, as geopolitical crises go away, as inflation is staying under expectations, there is no upside for gold. Okay, now, what to expect today? Okay, I've kind of broken it down into 5 different trading scenarios. Okay, the U.S. Nonfarm Payroll project is projected to come out today at 197,000 jobs. And a better expected print may heighten the bullish outlook for the dollar as it raises the Fed scope to future normalized monetary policy. The technical levels from the bottom to top for the euro are 138, 137.10, 136.15, 134, 133.20. So we are actually trading right now between that 134.40 and the 136.15. But this is where we will see the levels of the euro-US dollar move to. So we have 5 expectations. We're expecting 197,000 jobs. Okay. If it comes in with an expectations, that's the range that's around the forecast that is considered market neutral. So we're saying that's 189 to 199,000 jobs. That's going to be basically the neutral. Okay. But the euro may recover up to its upper trading range. Not the 138, but the 136.82 that I had on the chart. Above expectations, if we see something about 200,000 to 208,000, an unexpected high read could send the pair below one support line. Okay. What that means is if we get a strong read, the euro is going to go down because the dollar is going to get stronger. If we get well above expectations, that's above 208,000. Okay. If we get above 208,000, then that is a very, very strong outcome, and it could prop the pair to go to the second support line and could fall as a result. So then we'd expect it to go down to past the 134.40 lines. Now, if it's below expectations from 190 to 198, a weaker read could push it above one resistance line. So in other words, we would go up to what we saw in the charts before, which was 136.05. If it's a very, very bad report below 190, it could push it down up higher to 137.10. So this is the 5 possible scenarios we can get today. Okay. Now, you have to now add in the back of your mind the revisions and the unemployment rate. Okay. So what will happen is if the revisions are very strong upward, imagine what it's going to do is if we got the range at, say, it printed at 199, and we got a revision upward for last month, and unemployment also fell, that would push us into the above expectations because it's going to be enough to push you into the next range. So you have to weigh these. These are finally weighed into figure out what area you should go. Now, we're not going to trade blindly. What we're going to do is with binary options, we're only looking for a small movement of momentum at this release. So what we're going to do is we know our scenarios. If one of these things happen today and we can put the results into one of these scenarios, and then if we can go verify that the traders, the central bankers, the pension funds, the hedge fund are doing exactly what we predicted it would happen in one of these specific ranges, okay, so what they're doing is validating our trading rules, then we can go in the market and trade. So we're not going to be in a rush to jump in the markets the second this happens. We're going to sit back and let these happen and see which one of these first we're going to evaluate the result, the release, and see exactly which one of these trading scenarios we're dealing with. And then we're going to go on to see if the market is reacting as we thought it would. If we have those two things happening, then we can go in and make a trade. Okay, Jessica asks, so I should trade which asset? Today, Jessica, you can trade any asset you wish to trade. Okay, I can't in class teach you how to trade all the different assets. Like I explained, this result will have an effect on the U.S. dollar. The U.S. dollar is going to push up or down, and it's going to push up or down a currency. I can only show you in class one asset. I can't watch the whole market and run the class. So if you prefer to trade against the pound or the Canadian dollar or the Japanese yen, you can feel free. The same scenarios would basically hold true because it's the strength or the weakness of the dollar. But then you have to decide on your own what you're going to do. So today in class, we're only watching the euro, U.S. dollar, and gold. As an individual trader, you can set your own preferences. Plus, I've got about 20 things open and screens open. You can have, technically on your computer, you can have the screens open, all the different assets you want to watch, and watch them. I can only share one screen with you at a time. Here, so for class, we're going to be looking at the euro, U.S. dollar, and gold only. Okay, you can take your own preferences. Okay, we have about a minute before the forecast comes out here. So, again, what we're expecting is 197,000 jobs. The forecast is between 190 to 210. The previous was 203,000 jobs. Okay, so we are going to sit back and we're going to go over. You can go to any economics calendar you want. I'm going to take the whole class right now over to Forex Factory because it's my favorite calendar. And it should pop up on your screen. Now, I'm going to ask a favor of each and every one of you. Because when I'm doing the class, my refresh rate is very, very slow because I have a zillion screens open. I'm sharing my screens with all of you all over the world. So my refresh rate is not as fast as it should be. So this report, okay, will pop up on this screen. There we go. So you see the green balls that are just popping up there? That means they're getting ready to print out. I'm going to have to keep refreshing this to see the numbers. If any of you see the numbers before I do because your computer screens are refreshing faster, no matter which calendar you go into, if you can type them into the screen and share them with me, I would greatly appreciate it. They should be coming out in just about a minute. They do get released right on time. The clock is telling me here is 1:29. We'll see them pop up here on the screen. Okay, and as soon as they do, we'll go back to the 5 trading scenarios screen to take a look and see exactly what's happening. So we're down at exactly 1:30 right now. They should be popping up on the screen. Like I said, if anybody gets them first on their computer monitor, just type them into the screen and share them with me first. Because all of these feeds are just the same. It really depends on your internet speed. And like I said, my refresh rate is very, very slow because of all the, all the windows and everything that I'm doing with you guys right now. So we should be getting the first results out here for. I'm going to go to MarketWatch headlines because they also have the data. Okay, here we go. U.S. economy adds just 74,000 jobs in December. Okay, so that's 74,000 jobs. That's a very bad number. Let's see if we get the rest of this out. Okay, here we go. Meanwhile, unemployment fell to 6.7%. Now that is a very, very good number, an absurdly good number. The biggest increase, adding 50. Okay, I'm just reading the rest of this release here. Okay, the employment gain in November, meanwhile, was bumped up to 241,000 for the first week of 2. So see, what we did is we actually got a increase in a revision upward of 38,000 jobs. So with a drop in unemployment and a drop in a revision upward, we have two positives weighing against an extremely bad negative. So I'm going to take you back to the screen right now that we were looking at. We'd have the scenarios. We're going to decide as a class which one of these scenarios is going to hold. It should be the one that is playing out. Okay, so let's go back. Hold on one second. Okay, so what we're looking at is below expectation, below 190. In this scenario, the pair could move above the second resistance line over the coming months. So we're not looking for that. We're looking for the initial result. What we should see right now is the dollar tumbling and gold going up. So let's go see where we are at the moment in the markets and see exactly what's happening. I'm going to take you over to the live charts, and I'm going to take you to the Option Rally website, and we'll take a look at where the euro US dollar is trading at the moment. Okay, now you're looking at the chart for the euro US dollar and what happened. Look at this, exactly what happened. The dollar fell tremendously, so the euro soared, and it soared up to 136,435, okay, is where it is trading at this moment. Now, what's going to happen is we're going to see that this is an overreaction, and we're going to see an adjustment come in here because the traders first reacted to, and you can see this immediate reaction right here where the traders reacted directly to the number. Now we see it drop down as they adjusted the unemployment number, and then they saw the revisions. And what we're going to see is this is a beautiful scenario for the euro to trade the euro going down. It's topped out at 136.60. If we can get it 136.60, and we have a 1340 close, I would take a 1350 close because 6 minutes to, and we could take it to go down. It's going to go down because the traders are going to adjust when they understand that we had a huge revision upward at unemployment rate. No. So what we did is we took the euro going down at 136.60. Okay, let's take a look at where gold is. Gold should have skyrocketed. Okay, we're looking at gold now. Look exactly what happened to gold. Gold climbed from 1233 to 1243. Gold has jumped $10. Now again, this is a three-part scenario. You have an action, which is your immediate action. Then you have an adjustment, and then you have a correction. Okay, so what we're doing is we are still dealing with the action, the overreaction, because the traders are just jumping in there and pushing everything up sky high. They're pushing gold up sky high. They're overreacting. We're going to have the adjustment as they absorb this whole entire thing, because unemployment being that low, and it's hard to understand, because what we had is this is the results from Christmas month. Okay, what happened is a lot of it can be accounted for because what happened was we had very, very high hiring in November as opposed in December. Okay, a lot of that can be said that the Jewish holidays fell extremely early this year. They fell in actually November. So we started Christmas shopping and holiday shopping earlier than usual. If the stores, because they were really pushing out Black Friday and earlier sales this year, put on their Christmas staff earlier instead of after December 1st. So we had that big jump up of hiring in the month of November. Okay, and we can see November was 100,000 over, and the 2 months together still average where they should have been. Okay, and unemployment has also fallen. So it's not horrible, horrible report. It's just a bad report. But the Federal Reserve adjusts their monetary stimulus on unemployment numbers, not jobs creation. And unemployment at 6.7% is extremely good. So we can see that gold is holding here at 1244. It's hardly moving at all. Let's go back and see where our euro. The euro is at 136.65 and still climbing. Okay, it's going to adjust itself shortly. Let's go back over and see where the euro is going. Okay, and since we have a minute or two to watch this, because Jessica asked, we're going to go take this over and the screen is black. I'm looking at what says the audience view, and everybody says that they can everybody see my screen? Maggie says that she's only seeing a black screen. My computer's showing me that everybody's seeing. I have what's called an audience view. I'll refresh the screen here. Okay. Okay. So since Jessica asked earlier, we're going to go look at all the crosses and see. Let's take a look. Look what happened against the Japanese yen. We see the dollar has fallen, gotten very, very weak. The dollar fell against everything. Okay, but you see, look at the Japanese yen is now turning and recovering. Let's go see where the euro is going at this moment. Okay, you see how the euro is recovering here? Okay, it is now making that adjustment and coming back down because it went up way too high. And see, we are way in the money at this point. We've made $90.50 on this trade. Now, what will happen is this is called the strategy of three. And I'm going to be putting a new article on our website called the strategy of threes, and you'll be able to follow it. There are three parts to a report. Again, it's the action, the reaction, and it's the action, the adjustment, and the correction. Okay, and what we see here are we are in parts. One is terminated now. We see the total action, and we pushed the euro all the way up to 136.60. Now we're looking at the adjustment, and then we're going to see where the traders have had a little bit of time to evaluate it, and then we're going to see it. We're going to probably see it drop down lower than where it is, and then we will see it adjust to where it will start trading for the rest of the, well, this is a weekend now, and the markets will close, but for the rest of the day. But see how we got in a perfect trade. I mean, we are well in the money here. We traded at 136.57. It's down at 136.35 because we got it towards the peak. What you want to do is watch for that adjustment, that reaction, and as soon as you see that reaction ending, and you can definitely see it, you can enter for a trade in the opposite direction, and we can then sit and watch for this correction and then the adjustment, and we can trade for a trade in the opposite direction then also. So it's three parts. The first part you cannot trade because the first part takes place so quickly that you can't get, you don't know how long it's going to keep that momentum to keep you trading. So what you want to do is sit back and watch the markets. This is the time where you get to sit for those few minutes, those 5, 10, 15 minutes, to watch what the traders are doing. It's where you can catch your breath after the release comes out, go back like we did today and compare everything that was happening in the markets, figure out which one of your scenarios was correct, and then get ready to watch what's happening and make your trade. I think what we're seeing here is the beginnings of a correction. You'll have to watch a little bit longer, but I see the euro jumping back up, but not steadily. But you see what we're doing is we're now getting the correction. We had the action, the adjustment, and now we're getting the correction. See how the euro is now moving up and down? So it's staying right around this 136.30 range. Okay, and you could, if it beeps down a little bit lower than this, if it comes down to 136.25, 136.26, it's probably going to be back up to that resistance line right here. Okay, but as you see, it was fairly easy. If anybody has any questions, type them into the screen. But you see, it was fairly easy to make this trade. We had no risk. We had no gamble. We are in the money, well in the money. And even if we wanted to sell our trade right now, well, let's see if we could trade it and sell it back. We could sell it back for $82.86 and just take our $32 profit and be done with it. So we know we've locked in profit for the day. And that's how we do it. And we do this over and over. This report is released 12 times a year. And this happens in almost all of the major economic reports. And you can come up with these scenarios ahead of time and trade exactly this. And you can watch them. If you watch them, you will see this series of 3 steps happening over and over and over again. Okay, does anybody have any questions? Okay, we are staying at this 136.30, 30, 31, 32 range. So like I said, if we see it fall down to the 136.25 range, I would trade it going up because it's going to end up at this support line sooner or later. But you have to watch what the expiries are also. We have a lot of expiries open. So if we see it falling down, well, as we see it coming down, here we go, 136.24, 136. Okay, so I would say we could take a call here, apply it, and approve it. And now what we've got is, on my computer, we have 2 trades pending out there. One is the call when it pushed up. One was the put when it topped out here and came down. Now we have the call going up, and it should stay in this range. It should stay at somewhere close to the 136 range. You see how it's hugging that number right there, and we should end up in the money in that range. We took a larger investment in the first trade because that was a very good, easy trade. Where the correction is going to end up is basically timing. But we're in the money in both trades. It's doing exactly what it said it is, and that is right at, remember we had that support, that resistance line at 136.41, and it's staying pretty close to that number. We had the support line at 136.08. Yes, Stan asked, can we sell the trade if we're in the money? Let's go. We have both of these trades in the money. We'll sell them back and we'll nail our profit right. Okay. We can sell the trade we just made, the $12 trade, right now for $19.30. So we're going to sell that back. We sold that, and we booked that profit and put it right in the account. The other trade, the one we made earlier, is too late. You can only sell them in certain periods when the sell is blacking out. Once you get very close to the close, you can't sell it back. Okay. But we could have sold it about 2 minutes ago. We were able to sell that trade. When I was showing the examples, remember it was going to pay us back $82.66, and we had invested $50. Okay. So there is a window of time. So we sold the first trade. We can see that here in the expired trade, and we took $19.33. We invested $12, and we took $19.33 back. So we made $7.30 in about 7 minutes. Okay, on that trade. And we still have our open position here, which is going to pay us back $90.50 in a few more minutes. Okay. Yes, selling back a trade is a risk management tool. The main reason is to sell back if you are losing. If the trade is going against you, you can sell it back at a smaller loss. So if you invested $100 and the trade has gone against you, Option Rally may only offer to buy it back from you for $45. But you're better off selling it back for $45 and losing the whole $100. This way, your loss was $65 instead of $100. Okay, it's a very, very smart way to do it. Anytime a trade isn't doing what you think it should do, then close the position and take your money. Okay. Sometimes, if you've invested like we did here and you have an opportunity, always take your profit and run. I mean, I'm a firm believer of that. Now, don't say, okay, I'm going to take $1 and close out a $100 trade. But if you have the opportunity, like if this would have paid me back $85, $90, 80, well, it was 82.66. If I hadn't closed it, not cut the close, I would have sold it back. I would have taken my $32 in profit and been very, very happy. It means we would have booked 32 on that one, 7 on this one. We would have walked away in our half hour of conversation with a $40 trade, $40 profit. Anytime I can make $40 profit real quickly in 15 minutes, I'm a happy camper. That's $160 an hour you're making in profit. Okay. It's a good way to trade. But on that note, this trade is so far in the money, it's not going to go out of the money. The second trade, if we would have kept it open, we didn't take our profit, is very much in the money. And we'll go over and take one more look. And we'll take a look at gold and see where gold has gone right this. But gold should be duplicating the euro. Well, look at that. If we reverse the picture, gold looks just like the euro, doesn't it? It tumbled, it skyrocketed, tumbled down, and came back. Okay. It is, okay. So we have the two assets mimicking each other. So gold is working exactly opposite of the U.S. dollar. Okay. Because what we saw was the euro making this picture because it's the euro against the dollar. Here it says gold. Okay, and nobody has any questions, I'm going to sign off and say goodbye. Hopefully, if you traded with me, you made you have closed out one trade profitably, and you have another trade sitting here that you're going to sit back and take your $40.50 profit on. Okay, and that's it for trading the Nonfarm payroll report. It was an interesting trade. It was an interesting day. I was very surprised at results. I thought we'd see 150, 160,000 jobs created. So it's shows you how good all the professionals can be, how wrong everybody can be. Nobody expected that number today. Okay. If you have no more questions, I'm going to sign off and say goodbye to y'all. And you can see where this trade is definitely in the money. Let's go back and look at it one more time before we sign off, make sure we have made profits. Okay, hold on. Let me bring up the euro US dollars on the screen. Okay, it's trading at 136.40, which remember we were talking about the support resistance line. It was at 136.41. It's staying right under that. So that is the second trade that we traded down at 136.25. We knew it was going to go up somewhere around the 136.35 range. We knew we would be fine up there. We entered the markets all the way up here when the market turned down to make its adjustment. And we entered this trade at 136.72. We're 30 pips away from that, so we're perfectly fine. And that trade's going to close in. Actually, I'll stay with you till the trade closes. So we have about a minute before that trade closes, and we've made definite profit on that one. So we had two extremely good trades today following the economics. That trade is now closed. We can see in the portfolio, we sold this trade, we won that trade. We walked away today with $200.30, and we had a total investment of $112. So it's a good day of trading. Okay. Thank you very much, ladies and gentlemen. Hopefully you'll join us for, actually this month we have a very interesting trade, live trading. We're going to trade the German Zoo economic consumer confidence report in the middle of the week. I think it's 2 weeks from now. It'll be the first time we've ever done something like this trade. It's a great report to trade, but usually we stick to the big events. This is a small Eurozone event, but it's very, very important. So hopefully you'll join us for that one. Okay, and I'll say goodbye to everybody. Thank you very much. Have a wonderful weekend, and thank you again for joining me for the Nonfarm Payroll Report. Bye now.